Thank you very much, and good morning, everybody. I'm sorry for my small technical details this morning, but we're up and running. First of all, let me just start with one question that is going to go through everybody's mind, and that is, if what I'm going to show you today is so good, what the hell am I doing sitting here talking to you all? Well, I've been trading since 1986, and let me just tell you, trading is a very insular business. And just by chance, the algorithm that I came up with got out into the general public through a broker friend of mine who asked me to share it with his customers, which I did, and then it rolled on. And I must say, we've got many hundreds and in fact thousands of customers worldwide now who use this algorithm and the full Hawkeye suite to predict price and using it over triple time frames. So I'm going to take you through this today, and I'm going to have a special offer at the end, which is a hugely discounted offer on the volume indicator. And I'm going to show you really how it works. PowerPoints are pretty boring, so I'm going to rattle through the PowerPoint relatively quickly and then get into charts. And my business partner, Randy Lindsay, is in the room too. I would love you to ask me to look at any markets that you so wish, and I'll pull that up. And in fact, I'll go and look at the previous presenter. He was saying the crude was triggered. I don't know what time frame that was on, but I'll go and look at that as well and see if volume was confirming that. But yeah, I started with graph paper and a pencil. I know I don't look that old, but I am. I'm 66 next week, and that started my trading career. So let me start taking you through the presentation. But first of all, we've got to have the normal disclaimer. This is for training purposes only. If you're not happy, please leave the room. So let's go through that. The agenda. I'm going to give you a quick introduction to volume. I'm going to show you the application of volume, and then there's going to be closing thoughts and questions. Now, the questions are really where this presentation or any presentation gets to the nitty-gritty, because it's you that makes this presentation. I'm going to take it through to its conclusion with you, and then I'd like you to ask me to look at any currencies, commodities, futures, the S&P, etc., etc. Ask me as much as you like, because that means that we have an interactive session and all of us get the most out of it. So between 70 and 80% of traders are failing. You knew that when you started. And the reason for that is manyfold, but one of them is that most people are using traditional trading strategies, the MACD, stochastic, Bollinger Band, Elliott wave, moving averages, etc., fractals, whatever it is, it goes on. And these strategies don't work, because if they did work, why would 80% of traders be flicked out of the trading game? One of the things that you must do is do a lot of work on your own mental fortitude. And if you go to the Hawkeye website, we do have an affiliation with a terrific psychologist who understands Hawkeye and takes you through the mental steps to give you strength in trading. But anyway, 70 to 80% of traders are failing. They're all using traditional strategies. And that's why volume is so important. It is, if you think of it, the only leading indicator. It's truth. It is what it is. It shows you on bar by bar what the market is doing. It's not looking at accumulations over periods like lagging indicators. It's telling you. It signals price movement before it happens. And I'm going to show you charts today that you will see where the professionals are buying and selling the market, and you'll be able to follow that. So it shows that market intent. All other indicators are lagging, and volume on triple time frames is the key. And when I say triple time frames, let's say you do a 5 minute, I like to double it to 10, and I like to double that again by to 20. I know that if there are MT4 people in the room, you are set to certain time frames. There is a way around that. And if you want to know how to set MT4 to your own individual timeframes, there is something on our website, a paper that tells you how to do that. The volume on triple timeframes is really the key, because what you have to realize is that you are trading risk. You are not trading gold, you're not trading crude, you're not trading the British pound, you're trading risk. You want to know what the risk of the trade is. And triple timeframe smooths that risk out for you, and it shows you the least risk when you enter a trade. I want to tell you a little bit about my journey because it's pretty interesting, and I don't know whether it's atypical because the world has changed. But I started off in the publishing industry, and I had a pretty successful company. It had 300 odd people working for it, 16 magazines, and I sold that in the beginning of the 1980s. And I invested 6 figures with a stockbroker because I went off and was one of the directors for the America's Cup. If there are any sailors in the room, you all know what the America's Cup is, when it was held in Australia. And when I went away, I met a stockbroker at a drinks party in London, and I knew nothing about trading. And he sort of promised me the world, and I left him 6 figures. When I came back, over lunch, he told me he'd lost it all. Well, I thought he'd ripped me off. So I got all the cover notes, all the trade notes. And in those days, there were no computers around really with data. You used to get a weekly book with weekly charts in it, which had daily charts and weekly charts and monthly charts of whatever you were wanting to look at. And I was basically trading gold. And I had a long wallpaper, a table out in my trading room with graph paper, and I was doing the open, the high, the low, and the close out of the newspaper. And I started to trade, and I got to tell you, I was absolutely appalling, and I was quite impressed. It took the stockbroker so long to lose the 6 figures because I doubled that in about a third of the time. And what I realized in trading, it is very difficult. You have to be a loser first. Everybody, whoever they are, starts off and you lose money. Very few people come out of the trap earning money straight out. And of course, whilst you're being a loser, you wire yourself up for fear. And that is why you have to overcome your mental demons to be a successful trader. And until you have, you never will. There's some great books out there that will help you. Mark Douglas, Trading in the Zone, any work by Dr. Van Tharp, Trade Your Way to Financial Success, and Super Trader. They're all great books, and you must do work on yourself. I even reached the stage when I was trading that my analysis was so bad that if my analysis said go long, I'd go short. And funny enough, it started to work. But of course, you can't continue to do that with and be a human being at the same time. So I thought, what I've got to do is I've got to go and see where the professionals are trading. So I went off to the London Stock Exchange. And in those days, of course, it was before Bin Laden had been around, so you could just go in, and I went into the balcony area and watched the guys trading in the pits. And I went there religiously for 2 weeks. I treated it as a job. I went there when it opened. In those days, it even closed for lunch. I went out at lunch where the traders were and got to know some, and then I went out in the evening with them. And I was really trying to find what these floor traders had, and I found the missing link. After 2 weeks, it was so bloody obvious what they had. And their advantage was 3 things. They had accountability. In other words, they worked for somebody. You know, when you're trading, you're really only accountable to yourself or your partner, and you don't have a boss who can see everything. And I'm pretty certain that the majority of people in the room today, even with their partners, tell little white lies. How's it gone today, darling? Oh, very, very well, thank you. Oh, yes, it's been a great week, or da-da-da-da-da. The accountability side that the pit trader has, there was nowhere to hide from their P&L, their performance. They also had free money. They had the spread. We can't do anything about that. So, you know, they had the bid and the offer, free money, and they could load up and do substantial size trades just on those spreads. More importantly, they could feel the market. They could feel the buying orders coming in and the selling orders going out. They had the feel for the market. I don't know any of you who've been to any exchange, but the Merc in Chicago, if you go in there, they've got the neon lights going around with the price, the volume, and when it opened and closed. But let's say they're in font sizes, the font sizes would be 10, but the volume font size that goes around is 20. The guys on the floor want to know volume. They want to feel the market. And if any of you have read any of the books that Jesse Livermore did, going back to all the great guys trading the market by just watching the ticker tape, all they were doing was just feeling price and volume. They could feel the market. And that's volume. And when I came to that conclusion, I really hadn't looked at volume at all. I was just looking on price. It is what I call it, the DNA of the market. It gives you the thumbprint. It tells you what's happening. And that's volume. I knew it was the key then, and I had to do something about it. So I started my education. And of course, the father of volume spread analysis is Richard Wyckoff. He was around in the 1930s, and he studied volume and price. So I traveled to America. I went to Phoenix. I found the Wyckoff family. They had a small little printing store in a corner of a shopping complex. And I managed to buy a copy of his original course notes, put them in a U-Haul trailer, and brought them back to England, where I started to read and go through them in great detail. Got those course notes, took them back. And there was one thing that struck me. As I was going through it, there was an aha moment. Standard volume spread analysis, and if you look at other guys out there who are doing volume spread analysis, I haven't found anybody who considers the open. They all take the high, the low, and the close. And I started to ponder on why nobody does that, because I thought it was pretty paramount. And the reason for that is the markets have changed. When Wyckoff was doing his original work on volume, of course, we weren't in a digital era. We weren't in the computer era. And it took time for information to go around the world. It would come out of New York, Chicago, Kansas City, San Francisco, Los Angeles, then across to Tokyo, then Sydney, Singapore, back to London, etc. It took time. There was no specific open. Now, everybody sees everything at the same time. I think it is paramount, and I think it is what our USP, our unique selling point, if you like, is that we really seriously consider it to be an integral part of the volume spread analysis. It's very similar to an auction if you think of it. You know, if you go to an auction and the auctioneer has something that he's valued at, let's say, $100, and he starts the auction at $100 and there's no bidder, he goes 90, 80, still nothing, 70, 60. Let's say it goes all the way down to 20, and then somebody puts a bid in. Because it started at a value which was perceived to be fair value, but it went down to 20, it is unlikely to go back to its perceived fair value. It'll probably go back to a 40 and get closed out and be sold. However, if it went down from $100 down to $80 and then immediately a bid came in, it's telling you fair value is correct. And it is very likely that it will be bid up to 140, for example, rather than go down. Now, that's a very crude way of explaining it, but it's a very good way of showing you the absolute importance of the open in today's market. It sets the bias for the session. You know where that fair value has come in, and you know whether the fair value is being accepted by the market. There's going to be lots of live chart examples in a moment, so don't get bored and fall asleep whilst I'm doing this. So it sets the bias for the session, and once you have that, whether it be on a 5-minute chart or a daily chart, and let me just tell you, one of the biggest decisions a trader makes in his whole trading career is what time frame do I trade? And I've seen many hundreds of traders over the years who have attended my seminars, etc. And nearly everybody, in my opinion, goes about it the wrong way. They start off on a fast time frame, trying to get to a slow time frame. I would say it's much better to start off on a slow time frame and try and take a little bit of that price action rather than the fast time frame. And the reason that I say that, and I'm digressing off this for a moment, but it is very important. It's a bit like riding a horse trading. You wouldn't go and, without any knowledge, get a horse and go into the Kentucky Derby, but yet you're quite happy to go and trade the S&P on a 5-minute or a 3-minute chart, which is the Kentucky Derby. You know, when you learn to ride a horse, you have to get a pony, an old nag, etc., and work up to the racehorse. But I'll digress. You can ask me questions on that part a little bit later if you find it of interest. So the application of volume is where I'm going to go to now, and I'm going to go through charts and show you the setups that we're looking for on triple time frames. So let me just show you now TradeStation, and this volume indicator that you see here is what I'm talking about. Obviously there's a Hawkeye suite of indicators. I will show you that at the end, but the offer and the presentation today is understanding volume, and I just wanted to show you this. The volume indicator package, which I'm going to heavily discount at the end of this presentation, comprises of this algorithm here, these yellow dots here, which are Hawkeye pivots, which are isolated highs and isolated lows. And when I say isolated highs, isolated lows, they are what you would call island bars. For example, this is an isolated low here with the yellow dot, which means it has a lower low than the previous bar, it has a lower low than the next bar, and it has a lower high than the previous, and an island reversal. And you were expecting off these 3, 5, 7 time frame reversals, and you must know them because they take you as a compass through the market. You know, 1, 2, 3, 4, 5, 1, 2, 3 up here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. That was a big move, but I put this up because I'm going to show you something very interesting in a moment. And then we have these magenta bars which come in, which show you true range over a 20-bar period. And they're very, very important bars. Most of the time, this was in news on the pound USD yesterday when the governor of the Bank of England, Carney, announced that there is not much likelihood of rate increases coming into the British pound. So this is the indicator I'm talking about. This is the volume. These are the Hawkeye pivots, and these are white bars. That's what it comprises of. And I just want to tell you what's a little bit in the engine room of what we do here. It does over 300 calculations per bar, this algorithm. And what I've done is to break it down into 4 groups of 5 bars. So it goes back 20, looks at 5 bars, 20 to 15, and it weights. It looks at the standard deviation between the open and the close, the open and the high, and the open and the close, and looks at the standard deviation between the high and the low, and it looks at standard deviation between the close, the high, the close, the open, the close, the low, etc. And they are weighted all the way through, and when you get to the last 5 bars, they're weighted individually. So it gives you, as I said, the DNA, the thumbprint of the market as you're going along. And this indicator is available in the TradeStation package, MT4, Ninja, eSignal will be available on September the 8th, followed very, very shortly by multi-charts. And we're also trying to get it into Thinkorswim and Charles Schwab as a standalone indicator, and Bloomberg. So those are the platforms that are available right now: TradeStation, Ninja, and MT4, eSignal, September the 8th, followed very closely by multi-charts, followed probably the end of the year in the other brokerage packages. So we now understand what we're looking at here, and what I'm trying to do is explain to you what is happening. So let me just show you over here. Oh, there's one other indicator that comes in the volume package, and these are these little dots which I have on my slowest time frame. They are what we call the Hawkeye radar, and they comprise of three colors: the cyan showing you ultra light volume, the red showing you ultra high volume, and the yellow showing you high volume. And some of you will say, well, why is that come up there, high volume, whereas over there it required that height of bar to become volume? Because it's looking back over the last 5 bars and saying, no, that's the profile over the last 5. Now, yesterday, in the British pound, and I just want to show you how this was really taken up and picked up by Hawkeye volume. Now, for you people who are the Forex traders in this room, you'll say, but there's no volume in Forex. Well, we can use tick volume. So we take tick volume and we run it into time charts, and it is about 90% as efficient as real volume, if not more, and I like it. So we have several colors here, and let me just expand this out. We have red, which is obviously selling, we have green, obviously buying, and we have white, which is neutral. Now, right at the top of the market, before this announcement came out, you can see that the market was being bought. It was expected to be bought. Sorry, I should just explain. I put 2 other indicators on here: a moving average, a 12-period moving average, and a MACD, because this indicator works with standard technical analysis. Obviously, I think it's a lot better with the full Hawkeye suite, but I'm just demonstrating it to you so that if you like it and think it will be a good weapon in your arsenal, it is a standalone indicator. I will show you the full Hawkeye suite later on, and you can see it is stronger. But if we look here, you can see before this announcement came out, there was 1, 2, 3 bars of no demand volume up here, and it came after this magenta wide bar, and normally wide bars, the next price closes within the wide bar unless there's some incredible news that came out, which it did yesterday. And you can see that we have got these 3 bars of no demand, and one of the bars is a cyan, which is telling you that there's ultra light volume. Well, remember, the markets need fuel. It's the fuel in the tank. And if it's ultra light, it's going to tell you straight away that there's no momentum, there's no volume pushing the momentum up into this market. And then sure enough, we get our first bar of selling volume. And you can see this is a MACD at its normal setting, 12.26.9. And you can see that it's still rising. And that's why I said all the standard indicators are lagged. And it's telling you there is selling in the market. So that's on my slow time frame. And I want to carry on, because now we come down here and then, wow, that happens. And when that happens in a down market and you get ultra light volume that comes in, you know that the market has lost its energy to go down. It's going to go into its congestion phase. Remember, markets can do only one of 6 things. And we teach all this on Hawkeye. If you take this indicator, it'll also give you access to our free Thursday training room, but you have to be a Hawkeye owner of this indicator. And then every Thursday for about 2.5 hours, you will see Hawkeye in live being traded by my colleague Randy Lindsay. But at this point here, we have low volume. Now the market still continues down because I call it the tanker effect, but it is the first bit of what I call forensic analysis as opposed to technical analysis in the market. And I call it the tanker effect. If there has been high volatility in the market, it will still continue on down. It's rather like an oil tanker. It takes 5 miles if it puts the brakes on to stop. And it's a bit the same in a market. If there is a high volatile move and the market continues on down, it'll come down through this ultralight volume, but it is the first indicator that the market is going to stop. Now, as I said, there's only 6 ways a market can trade, and we teach this, which is trend up, trend down, trend pause, congestion entrance, congestion exit, and trend reversal. And if you understand and can tie volume in with the 6 ways a market moves, you now know exactly where you are in any trade that you take, and I can assure you, you have the edge. So when you see this here coming in, the market's had a big sell-off. It was like 1.5% yesterday on the British pound. You then go over to your middle time frame. So this is the 60-minute, 120, 240. I can make it whatever you like, but let's just keep going on this. And you can see that at that point of light volume, we had also no demand volume coming in, a little bit of selling. There is a red bar there, a little bit of selling, but it's no demand. The next bar was no demand. The next bar, a little bit selling came in. But it's showing you over here that you've got ultralight volume that came in. Markets do not go down on ultralight volume. Remember that. Never see me or hear from me again. Take that with you. They can continue on up in ultralight volume because markets tend to pause. And particularly if you're stock trading, remember stocks want to go up most of the time. So you'll get pauses where they have to go. And I'll come on to stocks and tell you the 3 phases that the market goes through there. So you can see we got no demand, we got ultralight volume. We come over to our fast time frame, and you can see that we have again no demand volume, a little bit of selling volume coming down, and then we get our first buying volume coming in. We've got a wide bar being tested, but now look, you can see that you've got the end of this down move here as this accumulation volume comes in. Markets have to accumulate before price move. And when we come to stocks, which I'm going to come to in a moment, you know, stocks go through a very logical phase. They go through accumulation at fair value, then the float is taken up. But when I say the float, remember a company only has X amount of stocks out in the shares out in the market to be bought. When the float is taken up, prices have to rise. They then rise to being out of balance, and they are then distributed. And the price then returns to fair value and is accumulated. And if the market is strong, it will be accumulated at a higher price than the previous point of accumulation, and the market will continue. That's why markets zigzag up and down. We also have something else that we need to look at. You can see that we have a yellow dot here, which is the isolated low. So we know we're going to get a minimum of 3 bars price action to go up. We also have that over here. The yellow dot hasn't come up because the high of this bar was greater than the high of that bar. We call that a phantom isolated low, and we teach you that in Hawkeye. And that's nearly as effective as a full isolated high. So we've got a phantom isolated low here. We've got an isolated low here. We've got low volume in a down move. We've got accumulation volume coming in here. Now we drill down to our very fast time frame. I say very fast, our fastest time frame, and you can see that we have the volume coming in here. But we are going through the phase of congestion. and this market will not go out, because if you were trading this, I would be looking to see two things happen. I would want to see a break of that high or a break of this pivot low. So until that area is taken out, I am not interested. I can see the volume coming in, but I don't see the momentum, and the market is going to go sideways in there. Now, before I move off this chart, Randy, have any questions come in specifically for what I'm talking about on this chart?
Not directed to those questions specifically. They're wanting to see some example trades of some markets that are moving, but other than that, no.
Okay. All right.
You're doing a good job.
All right. Thank you. So this is an interesting part, and we'll come on to look at that. Randy, I don't know whether we can get a feel. Is it mainly stocks coming through, or is it mainly Forex or the E-mini? Have you got a feel for that? Or maybe we could ask people just to type in
No, I don't. There's
FX
one
stock.
question that said, is this only for Forex? But I think there are all markets represented here, futures and stocks as well. So.
Okay. So let me now move over to stocks, and we'll come on to the stock positions. And these are the top stocks. Any stocks you want me to look at, type in now, and I'll look at stocks on a daily, weekly swing position first, and then we'll move across to stocks intraday. So if you have any symbols, please type them in now, and I'll come and ask Randy in a few moments. But let me just show you this again. What do? I look straight away over at my slowest time frame, my monthly. What phase of the market am I in? Well, you can see that we're in August holiday time, but we've got some selling volume that came in here, and we've got declining volume. So I'm not expecting a price move to the upside or downside on Google if I was holding it in a portfolio. If I come over to my weekly, I can see that I got a little bit of selling volume in here, and I could also see that my MACD is turning down, but this is the average is going up. But I can see that I got a pivot high here, as I have a pivot high on the monthly, and I can see that there's a little bit of selling volume in there. And if I come down to my daily, I can see also there that has been in a downtrend, but the risk was too high because it isn't a short. Although the volume is there, the price move that I'm getting over here is showing me that it's on declining volume. It's on light volume here, which means, guys, there's no momentum in this stock. There's not going to be anything coming in happening on this. And let's go and have a look at the most widely held stock in America, which is Apple. And we can do the same there. Well, now every chartist in the world will be seeing that you're coming up to a double top here. So everybody's waiting to see whether there's going to be a sell-off on that double top. And you can see that on the weekly, you've got the yellow pivot in there already. And you can see that last week there was no demand volume. So you had no demand volume that came in on the weekly after that pivot high, which gives you a double top, confirmed over here, and you've got your declining volume that's coming in here, showing you that there's no momentum. You'd expect that this time of year when most people are on vacation, which I am at the moment. And you can see that we had a little bit of a sell-off here, and there's the pivot low pushing it up. You know it's not going to go anywhere. Why? Because you've got this green declining volume coming in. So you know that there is no trade on here. It's a high risk trade because there's no momentum. Let me go and have a look at another stock. There's ICE here, which is the that hasn't been around long enough. Let's move off that one. I like to have a minimum of 500 bars, but of course you can't get that on the monthly charts. So I like to have a minimum of at least 30 bars on the monthly to be able to see what's happening. and Netflix, which is a highly traded stock, and I'll come on to that in a moment on intraday, we can do exactly the same. You can see that the bias is to the upside. You've got a bias to the upside, you've got the volume coming in. Okay, a little bit of increasing volume last week. Now, a lot of you would also say, let me just make that a candle stick so you can see. That was a down bar. You can see that the candle closed and it was red. The volume indicator called it buying volume. And that really is a great demonstration of the power of the Hawkeye algorithm, because what we're looking at is that if it was selling, the spread of that bar would have been larger. So it was just some profit taking. It wasn't a sell. It was just saying, okay, there's a bit of movement in the market. It's not a sell. If you look at any traditional volume indicator, that would have come up red for selling, but it's not selling. It's just holding it, because if it was selling, the range of that bar would have had to have been greater. So the bias is to the upside, and you can see that we have that bias here on the weekly. Why do I say that? Well, we're coming from these pivot lows, these yellow dots here on green volume. We go up, we put a pivot high in, we got red volume, 1, 2, 3 down, bang, there it comes in, it's sweet as a nut, and there's a little bit of selling volume in there, but it hasn't driven it down. And now we have last week no demand volume, which is confirmed over here on this slower chart with declining volume or not great volume coming through. And if we come down onto our daily, you can see that that is declining all as well. And if you were using traditional stuff, the MACDs turned up. So the bias is to the upside, giving you the same bias as the monthly, pushing it up to the highs again and pushing it through. But let me just tell you, it's got a lot of work to do to get through all these pivot highs across here. Randy, is there any particular stock that somebody would like me to see on a daily, weekly, or shall I move to intraday?
Yeah, they're looking at silver or gold, the ETFs, which are SLV or GLD.
Yeah. I'll do silver and
Amazon.
gold. That's on commodity. Is that on daily, weekly, or intraday?
These are all daily, weeklies.
Okay, so let's look at Amazon. That's Amex. Amazon, what's the code for Amazon?
AMZN.
AMZN. She got me talking like an American. AMZN. So, I don't know. Amazon hasn't been around that long? It's been around longer, 20 years back. It's the only data I've got. So let's come over to the weekly. And again, you can see on the weekly, we have got selling coming into this market here, which is also confirmed over on the daily with the red dot showing us ultra high volume. There's the volume, but bang, ultra low volume came in on the volume radar. We know markets don't go down on ultra low volume, so we are expecting this to go up, and probably if you are a gap trader, you'd be looking for that gap to be closed again. So that's what we're looking for. We also have that very nice pivot low behind us, as we have over here on the weekly. We've got a phantom pivot low on this bar pushing it up, and we've got it on that bar pushing it up as well. Give me another stock, Randy, for daily, weekly.
Tesla, TSLA.
I have that. Again, not enough data, but we've got a bit of green buying volume coming in. And again, so the bias is to the upside here on the monthly. And you can see that the accumulation started to come in here. There was the weekly green buying, pushing it back up. Confirmed over here on the faster time frame. Ultra high volume came in there, pushing it up. You can see the accumulation phase going through here. It's being sold, bought. A test, as we call it in volume spread analysis. Another test, The market didn't go down on either of those test bars there, telling you that this is going to be a good long. And you can see that it also formed a double bottom on these pivot lows here as it's pushing itself up. The only thing I'd be slightly hesitant if I was trading this on a daily basis. At the end of the day, we're going to get a yellow dot at the end of this bar if it continues in that same profile, and that will push the market down. But that is the analysis on that. One more daily stock, Randy, and then I'll move on to other markets.
Okay, Twitter. TWTR.
That's TWTR.
That is right below Tesla.
Well, thank you. Hasn't been around that long, but you can see what was happening from the original IPO. It was being sold, profit taking coming in, but look what's happening down here. That, once you become attuned to the Hawkeye methodology, is a phantom low on this bar. Let me just blow this up a little bit on this weekly and take it across, please. You can see that that is a phantom low, and now the market comes in and you can see no demand there, and now the accumulation, a volume test. Nothing happened. It wasn't continued to be sold. That was your big clue that the market was going to go up. No demand volume there, telling you that there was no selling on that bar, preceded by no selling. It was being accumulated. And there is 1 week before the market put in a range where it went up from, it opened at 38.30 and it went up to $10. A week before that move, the volume algorithm told you that's where it is, boys. Drill down in your time and you come over to the daily, and let me just expand that out so you can see it with clarity. This is a good example of volume spread really in great action. You can see, just see if I can get the volume a little bit larger there. You can see that we were coming down here, and there's the no demand, low volume coming through, and there is the first buy, 1, 2, 3 bars before the gap up, 4 bars. There was the high volume. Don't tell me that people weren't in the know. Don't tell me people weren't in the know on that bar, because look, the close is less than the open. Normal volume analysis would say that was a selling bar. Hawkeye is saying it's a strong buying bar with a red dot on it, giving you ultra high volume, pushing it up, bang, up it went. Profit taking, down it came on declining volume. Markets do not continue down on declining volume, and bang, there's the no demand for any appetite for selling, and a bit of green volume came in yesterday. So that was a very good one. I'm just going to go on to intraday for stocks, and then I'm going to get on to what I trade mostly, commodities, and then we will go on to the E-mini. So let me just show you stocks intraday, and again, if there are any great stocks that you like, I'll be putting those up. So intraday stock people, please put in your time, and I've gone very short, 5 minutes, 10 minutes and 20 minutes, because I just wanted to show you that it works on all time frames. And let's go through Apple again. The dotted line here shows you the commencement of the day, and you can on that bar, you had the accumulation coming through, green, 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 no demand, a little bit of selling volume that came in off that pivot, but again, not interested until that low is taken
Nigel,
out. Or that,
I think there was I think the internet blipped on you. You need to reshare your screen, please.
oh. Does that do it, Randy?
No, you're not sharing yet.
I'm hitting desk sharing. I'm hitting it. Is that showing it?
It's starting to come in. Now it is. Now you can, yeah, we can see your TradingPub chart now. You can go over to TradeStation. There it is. Okay, good.
Yes? Okay, thank you. I'm sitting in a hotel, guys. I'm on holiday, and I had to find I got sorry, I've got to gather my thoughts here. You can see that the bias is to the downside on here, and the reason the bias is to the downside is that I have the yellow pivot high there. I got a lower yellow pivot high here. I got one here, pushed it up, started to come down. Look at the volume here. I've got declining volume, but again, it's come in on the 10-minute as one as a trade because there would be too much risk. Let me look at Netflix. I don't think my charts are live, Randy. They're not updating, but that doesn't matter. I can see here that on the Netflix, this is interesting because you've got these wide bars down here on your 5 minutes. You've got red selling, no demand, red selling, and that also correlates over to the also see that you've got no demand on your 20-minute there as well. So all of that is telling me that this will be going down and will continue, but we've got to look at it. I want to rattle through now because I'm worried that I'm going to drop out of my internet. So I just want to get on to my commodities. My commodities are my main trading, and I just want to show you the full Hawkeye package just briefly. So when people say, what was gold? This is my gold chart that I look at. These are the commodities that I trade. You can see that I have my volume, I have my Hawkeye trend, my Hawkeye stops, and then I have my Hawkeye heat map, which gives me the bias of the market trends. If you want to know more about how we to the package, you go to hawkeyetraders.com, register. There's a free download book on volume there, and that'll give you access into our Wednesday room, which is free. And as I said, if you purchase the Hawkeye indicator, you can come into the members room, which is on a Thursday for 2 hours every week. And once a month, we also hold a 2-hour educational seminar on Hawkeye. But let me just come and show you how it would work on gold just as it stands. So let's go to our long term first. So what's our monthly showing us? Our monthly is showing us that we have no demand on gold, which means that this down move has come to a conclusion, and we are waiting for a break of that high at 139 or a break of that low to tell us whether we're in uptrend or downtrend. At the moment, it is in congestion, but that's monthly, which is far too slow, but it's telling you that there is no direction there. So even with everything that is going on in the world, it is a concern to me that gold hasn't got going yet as a hedge against all the horrendous problems that we have in Lithuania and in the Middle East. And then when we come to the weekly, we get confirmation of that. You can see that for the last 4 weeks, we've had a little bit of selling, no demand, a little bit of selling, no demand. And that manifests itself across into the daily, showing us, and let me just make that a little bit smaller. Again, here's the volume coming down here, and you can see that there's a little bit of accumulation taking place, and that one there, of course, is low volume. We know markets don't go down or continue down on low volume. You're getting the classic profile of accumulation coming through. So I would expect and remember, as a trader, you lose money by having opinions, I would expect that this market will move to the upside. When, I don't know. I don't have that facility to see into the future, but it will. It is being accumulated. It's not being sold off, and of course, the ETF for that is GDX. And if you look at that, it gives you a pretty good profile, but it's showing you that, remember, the GDX is the gold miners of the world, the Newmonts, etc. And that is showing accumulation. So it's showing you that the professional fund managers out there are accumulating gold mining shares, anticipating a price move in the underlying. And you can see all these pivots here. You can see the green volume coming in. You can see the green volume of accumulation on the weekly. And on the monthly, you can see no demand, accumulation, accumulation. So the gold mining shares are giving you a far better thumbs up on what's going to be happening in the gold area rather than the actual bullion price. What were the other markets people wanted me to look at on commodities, Randy, please?
Crude oil. Let's see, there was one other I missed.
The speaker before
and soybeans.
Oh, corn. Oh, I like corn. Good. The guy that preceded me doing his presentation said that the crude had just given a signal. Could somebody just type in what time frame he was looking at, and I'll go and look at that. I'd like to see it.
Well, I personally traded crude oil this morning on a 3, 6, 12-minute chart.
Okay.
In the in our trading room.
Okay. I presume it was a successful trade. Yes, Randy, it was a successful trade.
Oh, anyway. Of course.
Yeah. Okay, so again, let's go off and do our forensic analysis first. We have selling volume last month, preceded by a isolated high, yellow dot, telling us that the bias for this market was to the downside. Have I lost my internet, Randy?
Nope, you're good.
Okay, I heard a horrible bell noise. And over here, you can see on the weekly, I've got 2 weeks of selling volume also. And if you're looking at traditional indicators, the MACD turned down and the MACD was flattening out on the monthly. And you can see that it's rolled itself over here and is starting to decline. Let's drill down on the daily, and you'll see that the daily is showing me right here that it was coming down. Now, this is where triple time frame really comes into its own. I had red volume on my daily, I had red volume on my weekly, and I had red volume on my monthly. This was a low risk entry to take this short down here to hold. And now I know 6 ways a market moves. I'm in congestion through here. You can see that the price is just going sideways. Pivot low, pivot high, coming down, testing that. When this comes out of the 90, whatever that low was there, watch out. The low of that bar is 96.55. When 96.55 is taken out, watch out on this market. And again, the fund should be pushing this market up. With what's going on in Iraq, it should be pushing this market up, but it's not. The world is awash with oil, and that was shown in the oil statement that came out into the market yesterday, showing the inventories that are being held in the US. So there is a glut of oil at the moment. We're expecting this to start coming down. And I haven't got, let me just see, I don't want to, let me just do corn next. Now, what have we got here? Well, we've got the pivot high pushing itself down, and this little one here being set up looks like the beginning of another yellow dot at the bottom. And what do we have? We have declining volume. So we know that this market hasn't got the fuel in the tank to continue to push it down. And we're seeing that on the weekly. We're seeing that there's still selling volume coming in, but of course at the end of this week, we will see it starting to be pushed up. And you can see by drilling down on the daily, look at what has happened on the volume radar. High volume, ultra high volume. That was where the market is being accumulated by the professionals. Why? Because the bar isn't a very substantial bar, and you can see the market's flattened out. There's no demand there. The market was being bought 2 days ago substantially, and if I was short of this market, I would really be tightening my stops up, and you can see that your conventional indicators, the MACD, has gone long too. Soybeans.
Soybean oil.
We've got monthly. Oh, I don't want to. Okay. Let me finish this on soybeans, because soybean oil is quite parallel. It's obviously correlated. And I don't trust my internet now that it's been flicked off with trying to load something that's not in cache.
And we do have about 9 minutes left, and that's all. So just to let you know.
Oh, okay. I've been talking too much.
We need to wrap everything up in 9 minutes.
Okay, thank you. We've got this here. We've got our red volume on our monthly. We've got weekly red volume taking us down from that high there, pushing us back down. And now we have the red volumes. But look what's happening down here. The red volume, green, green, red, red. And we're not getting big price move off. So again, I would say it correlates back to the grain showing accumulation. I want to go into the E-mini time now, and my internet isn't working updating these charts, but you can see that here it was bringing it down yesterday, and then you could see that there was no demand coming all the way through here, and there was the green volume pushing you up onto that rally coming into the close, which was confirmed up on the 10 minutes and 20 minutes. Hawkeye does a lot of work on tick data. I want to show you the E-mini with the full Hawkeye suite on it. And this really is the key to understanding how to trade. It took me 5 years, 3 programmers to come up with this indicator, which tells us each day what tick speed to trade the market with. And this works on all markets, Forex, commodities, stocks, etc. It just shows you the tick speed. It just seemed crazy to me that everybody would trade the same time frame day in, day out, whether it be a 5-minute, 10-minute, or tick speeds. Why? The market has its own daily profile, and we need to know that. And then this indicator here tells you what chart to trade. So it's saying, hey, blue, look over here to the blue time frame. When it's yellow, look to the yellow, and that color, look at this chart. So it's keeping you in harmony with the market all the way through. If this is sounding complicated to you, it isn't. We have many, many users. It takes about 3 to 4 weeks to really understand this, coming into the rooms and working with us. But that shows you the whole of the suite setup. It shows you the volume. It shows you the heat map, giving you the underlying direction and the 3 different time frames. I just put the heat map on this one. And that's showing you that through this point here, it's showing that the market has lost its upward movement, which you can see it has. It's showing you 1 or 2 of the trends to the downside have clicked in, but not all of them. It's just saying out congestion, and you can see that our trend dot here goes white, and then it goes green, and up it pushes. So I've only got another few moments. I want to take you through the end of the PowerPoint, please, and closing thoughts. And we've done most of the questions. I've been talking too much, I think. So volume price analysis, this is a culmination of 20 years of research on my behalf, and Randy was a Hawkeye user. He joined me 8 years ago, and he has been working on volume since then too. It's an elegant, it's a sophisticated way of trading. It makes obvious sense to be able to use volume to show you what the professionals are doing, and it shows you accumulation before price move and distribution before selling. It really does give you that clarity of thought to see these trades clearly. Shows you how to perceive the charts, how to place your trades, and also when to take profits, because you tighten your stops up, and that's part of our education, that we show you when the market moves up into selling distribution volume. And it shows you obviously how to protect your positions and where you should put your stops. Now, there's a webinar special. This Hawkeye volume indicator has a value of $360. And as I said, it's available in MT4, TradeStation, Ninja, eSignal on September the 8th, and multi-chart soon after and later on in the year. If you are interested in it for later on in the year, I hope will be Think or Swim or Charles Schwab's, please send an email to us and we will honor this price for you. We have private group mentoring. Randy will be holding a 2-hour mentoring session to those people who purchased this indicator in mid-September. So it gives you 3 to 4 weeks to really start working with it. So you'll have lots of questions. And that has a value of $1,000 because we charge $500 an hour for our time. So that's a total of $1,360. We're also going to put in today that if you get this indicator, we will also give you access to our Thursday members training room, where Randy and myself from time to time go in from 8:30 Eastern time through to about 11 Eastern time, where we go through multiple markets, putting live trades on. As Randy told you, he put a live trade on the crude market today. So we're including that, $97. That's less than probably a dinner at Longhorn Steakhouse with a bottle of wine for 2. And if you want that, there is a link. Randy, have you posted that link in the room for people to purchase?
Yes, it is posted.
Okay, so there is a link for you to come in and acquire this. And that is the end of this presentation. I think I've got another few minutes, Randy, have I?
3 more minutes, yes.
Okay, well, 3 more minutes. Let me just go back to my charts and show you my commodity feeder. This is what I trade mostly on my own account. And you can just see that I look across here each day, and understanding volume, understanding the heat map, price movement, you can just see the strength of the algorithms showing me where it's coming in. It really is the thumbprint, the DNA of the market. And I would say this, for $97, go and get it, because it'll make a big difference to your trading. And as I said, you can use it with your conventional analysis that you have. Hopefully, by coming into the trading room, you will be seeing the Hawkeye suite of indicators, which includes, obviously, the cornerstone of Hawkeye is volume. And you will say, yeah, this is a pivotal turning point in my trading journey. So everybody, thank you very much for your time. Good fortune in your trading. If you want to know more, HawkeyeTraders.com is where to go. And that will give you all the information that you want to see. So just go to HawkeyeTraders.com and you can ask us many questions through there. You can contact support, team1 at HawkeyeTraders.com. We've been around as a company for 14 years, and we are as ethical as you can be in this market. We don't spam, it is what it is. And volume tells the truth. And please join the Hawkeye family. Thank you all very, very much for your time.
Well, thank you so much, Nigel. This is Raleigh here, and I certainly do appreciate your time and the terrific presentation you just shared with us on how you use volume and price action to spot these high-quality entries across a wide range of markets. I particularly was impressed with the way that you were responsive to suggestions from the audience as to markets to look at, and your quick analysis definitely demonstrates how your tools can quickly identify or give you information that can help you for trading. I also want to thank you for pulling together that very special and generous offer for the Trade-a-thon attendees here. That's a terrific offer, and I recommend that those of you who are in the room take a hard look at that offer, as it more than likely will help you build some more consistency in your trading. So once again, thank you so much, Nigel. I know you're on vacation, and I wish you a pleasant rest of your day. And Randy, thank you so much for your help as well in addressing many of the questions that came up.